Hey everyone, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Thank you so much for joining me on my YouTube channel to learn a little bit more about mortgages. Now today we're going to be talking about something a little bit more advanced. Now this type of mortgage is something that maybe even a lot of Canadians that have had mortgages over the years maybe have never even heard of, and if they have, they might not exactly understand what it means. Today we're talking about collateral mortgages. So that's a little bit different from a standard charge mortgage. A collateral charge mortgage is a little bit unique in that it allows the bank that you're getting the mortgage through to offer you additional financing down the road. It's a little bit complicated when it comes to mortgage financing for collateral charge mortgages. Some of the banks in Canada actually only do collateral charge mortgages. TD Canada Trust is one of those banks that every mortgage they do these days is a collateral charge. So what that gives them the opportunity to do is to offer you a second mortgage or a second line of credit later on down the road. If you've had a mortgage before in Canada that has a mortgage with a secured line of credit component, or commonly called a HELOC or home equity line of credit, then you would have had what's called a collateralized mortgage. So when I say standard charge and collateral charge, when you take out a mortgage, there's going to be a land title in the US that's commonly called a deed, where there's actually your address and the legal description of the property you purchased, and the mortgage lender and the mortgage amount of which they registered against the property. Now, in a standard charge mortgage, that charge is going to be for the exact amount of the mortgage that you took out. It's not going to be for any higher. A collateral charge mortgage is actually set up for a little bit higher than that, and often it's for the full purchase price of the home. So being that these collateralized mortgages are a little bit more complex than your standard charge mortgage, I've actually made up a little bit of an object lesson to help illustrate how they work. So I've actually got a couple of glasses made up here with some percentages written on them, and so we'll just head to my kitchen and I'll show you a little bit about kind of how collateral mortgages work. Let's go take a look. Okay, here we are. So what we've got here is we've got these two glasses, and I've added a little bit of dye to the bottom just so we can show a little bit of the difference. So what we've got is a collateralized mortgage over here and a standard mortgage over here. So let's say that you're doing a standard mortgage. Let's fill that one up first. So here we go, take a little bit of water. So this is your mortgage itself. So you're gonna say put 5% down. So you're gonna put 95% of the purchase price of the home is going to be in a mortgage. So there we go, standard charge mortgage being filled up here to 95%. And that is exactly the amount that the mortgage will be registered for. Okay, so that's how you start off with a 95% loan to value. So that means that you're purchasing a home with 5% down. So here's your mortgage, standard charge mortgage, the lid goes on, just like that. And so every time you make a mortgage payment, the balance goes down a little bit. So a little bit of water there. So as you pay the mortgage off, it just keeps going down. There we go. So that's just a standard charge mortgage, and that's all there is to it. As you pay it down, there's no adding anything to it. Now, here we go with our friend, the collateralized mortgage. Here we go. Same sort of deal. You buy the house, 5% down. This is actually to scale. So when you're financing a home, you're gonna be putting 5% down, so you're financing 95% of the purchase price. So there you go. There's your 95%. A collateralized mortgage, there's no lid on top. This actually, as you pay it down, it's going to allow room for you to be able to put additional financing on. So like I said previously, a second mortgage or a HELOC, commonly it's like a home equity line of credit or a secured line of credit. So basically what that means is that as you pay it down, leaves a little bit of room for extra financing. So once you get down to approximately 80% of what your current home is worth. So let's say you've put 5% down, you got a collateralized mortgage, and then you paid it down to about below 80% of what the home is worth. So this started out as a collateralized mortgage. There wasn't additional financing really in this equity here above 80%. So if you were looking to do a secured line of credit or a HELOC on your collateralized mortgage above the 80% level, there really isn't any equity. It's the same as doing a refinance here in Canada. You have to leave 20% of your equity in your home. So, but let's say you've gotten to that 80% level and you've paid it down a little bit. Now, so as you pay it down, a little bit extra here. So let's say you paid it down to say 60 or even 50% of the current value of the home. And then you want to do some additional financing, do a line of credit. Well, here we come along. That same bank is allowed to do a secured line of credit right on top of the additional mortgage financing in the collateral charge. So what the oil here that should be, it's bubbling, that should be separating, means that this is going to be your secured line of credit or a second mortgage. Now, quite a few different lenders offer different types of products. So like I said, TD has a collateralized mortgage program, as well as Scotiabank has their step mortgage, which is very much similar. So once you've gotten to that 80% level, you're allowed to do extra financing. As you pay that mortgage off a little bit further, so let's say you pay it down, you can go right back up to that 80% level in a secured line of credit or a home equity line of credit, or like I said, a second mortgage of some sort. So that's how a collateralized mortgage works, where it allows you to add extra borrowing on as you go. The standard charge mortgage, you pay it off, it's done, you close it. That's all there is to it. So that's all there is to collateralized versus standard mortgages. If you have additional questions about collateralized mortgages or mortgages in general, please feel free to contact me through my website. And thank you so much for joining me on my channel. Have a great day.